Let's just jump right into this explainer, because today we are looking at a financial instrument that's literally bigger than every single stock on Earth combined. We're talking about a staggering $145 trillion market. It's the silent plumbing underneath the entire global economy, and yet most of us barely give it a second thought. But here's the thing. If you don't know bonds, you genuinely do not understand how money works. And to understand why this matters directly to your wallet, we have to start with the heist thriller scale of March 9th, 2023. On this exact day, a Silicon Valley group chat triggered an absolute panic. It was a digital bank run that erased $42 billion in a single day. Think about that number for a second. It was just 4 little words flashing on screens. Pull your money now. That single phrase killed a top 20 US bank in just 48 hours. And you know what the wildest part is? It wasn't because of some shady crypto scheme or a rogue trader making crazy bets. No, it was because of government bonds. Which brings us to a fascinating question that we really need to answer today. How exactly did the safest asset on Earth kill a $200 billion bank? Well, it turns out that bonds, arguably the most boring financial instrument on the planet, actually have teeth. Very, very sharp teeth. So part 1, what is a bond actually? The simple math. If we strip away all the fancy finance jargon, a bond is incredibly simple. It's just an IOU. Step 1, you hand over cash today. Step 2, you receive a little interest every year as a thank you. And step 3, you get your original cash back later. That is the identical handshake, whether it's a Treasury bond from a national government or a corporate bond from a major company. Cash now, cash later, plus a little extra for your trouble. And that brings us to the coupon. This is the recurring interest payment you get on a bond. I actually love this historical fact. It's delightfully named after the physical perforated paper tickets that investors literally used to clip off paper certificates and cash in at the bank. The name outlived the paper by about a century. Then there's maturity. This is simply the finish line date when the borrower returns your original money, whether that's 2 years or 30 years from now. But here's the absolutely crucial point. Once you own that bond, you don't have to keep it all the way to maturity. You can sell it to someone else early. And that creates an active market where prices move up and down every single day, which leads us perfectly into part 2, the duration trap, also known as the Silicon Valley Bank story. See, during the pandemic, SVB took in an incredible $124 billion in deposits. Being responsible, they bought a massive mountain of long-duration U.S. government bonds. But here's the trap. Right? The bond market acts exactly like a seesaw. When the Federal Reserve hikes interest rates to fight inflation, the prices of older bonds with lower rates go down. Because SVB held so many long-duration bonds, the value of their portfolio plummeted, resulting in $15 billion in unrealized on-paper losses. And the math here gets ruthless fast. Unrealized losses are totally fine, unless you suddenly need real cash. On March 8th, SVB had to sell bonds early to cover withdrawals, locking in a real $1.8 billion loss. The very next day, spooked customers tried to withdraw $42 billion all at once. A simple cash squeeze forced real losses. And by March 10th, regulators shut them down. Just like that, the largest bank failure since 2008. All right, part 3, the Bond Vigilantes and how a spreadsheet fired a prime minister. So what exactly are bond vigilantes? Basically, they're investors who discipline reckless government spending simply by selling bonds en masse. James Carville, a chief political strategist back in 1993, famously realized that the bond market was powerful enough to intimidate sitting presidents and actually dictate national policy. It's kind of the closest thing capitalism has to a shadow council. Take September 2022, for example, when the UK unveiled £45 billion in unfunded tax cuts. The bond market's reaction was absolutely instantaneous. Yields spiked massively, the pound cratered, and a purely numerical bond market reaction dismantled a sitting government, forcing the prime minister's resignation in under 2 months. Literally, a group of bond traders dismantled a sitting government in just 49 days. Famously, a British tabloid live-streamed a head of iceberg lettuce to see which would last longer, the prime minister or the vegetable. Well, the lettuce won. They took down a sitting head of government faster than a grocery store vegetable could wilt. But hey, this phenomenon isn't just British. In April 2025, a sweeping round of U.S. tariffs was paused within days after Treasury yields spiked. The sitting U.S. president altered policy simply because the bond market spooked him. It proves a fundamental rule. You can out-argue a pundit, you can outvote a rival, but you absolutely cannot out-argue a chart. Which brings us to the most important part of this explainer. Part 4, why your wallet cares, and the machine setting your prices. This is where it really hits home. Bonds aren't just some Wall Street abstraction. They are the machines setting the prices for your everyday life. Your 30-year mortgage, directly tied to the 10-year Treasury yield plus a spread. And get this, a single Treasury auction on a random Tuesday in May quite literally sets the interest rate on millions of federal student loans for the entire year. When the bond market moves, your personal borrowing costs move right along with it. So even the I don't invest crowd absolutely must care about this. Your safe retirement account isn't immune to this math either. Because most target date funds hold bonds for safety, when bond prices crashed as rates rose, the main U.S. bond market index dropped roughly 13% in 2022. Let that sink in. The supposedly safe portion of your retirement suffered its worst year since 1976, all because of basic bond math. Now, zooming all the way out to the macro level, the U.S. national debt is currently sitting north of $39 trillion. And guys, it is growing by billions every single day. Because of the sheer size of that debt and the interest rates dictated by the bond market, the annual interest payments have now crossed $1 trillion, meaning the cost just to service that debt has officially exceeded the entire U.S. defense budget. Every dollar going to pay off bond interest is a dollar not going anywhere else. Which leaves us with this final provocative thought. If the bond market controls the rate on your house, the cost of your education, and the budget of your very own government, who really controls your money? Understanding this seemingly boring plumbing doesn't just make you a finance nerd. It makes you someone who can actually read the news, understand your bank statement, and see the next crisis coming way before it hits.